All right. Well, good day, everyone. We want to welcome you to one of PrimePay's monthly broker webinars, which has been in a series of webinars here for the last 8 years. Yes, folks, we've been doing this a while, so we hopefully, and one of the reasons why you may be attending here today is because of the great content and hopefully practical application that we provide each and every month. We are thrilled that you have taken time out of your busy schedule to sit with us today on this very important topic titled The Top 3 Common COBRA Compliance Mistakes. So welcome, everyone. My name is Steve Jackson. I'm the Senior Vice President of Strategic Development and Channel Sales here at PrimePay, and I want to welcome you today to this important webinar on this very important topic. PrimePay has had the awesome opportunity over these last many years, I guess decade or more, to be able to provide COBRA compliance services to our clients. And so we've been able to accumulate a lot of great metrics. We are able to receive a lot of great questions from our COBRA qualified beneficiaries, but also our clients, our employers. And over the last, we'll just say over the last couple years, there has been a common theme, a recurring theme of frequently made mistakes as it relates to COBRA. And that's truly what this webinar is centered around here today. We really want to focus on 3 key mistakes that employers are making on a regular basis. We also know how important it is for you as the benefits broker to be able to understand these key mistakes, because our goal in these webinars are for you to be able to take this regulatory compliance requirement or obligation, and after this webinar, be able to go to your clients and communicate it effectively. So before we get started, let me just cover a little bit of the logistics here for you today. We have a lot of folks on the call here today. It is great to see many familiar names that are on here today. So thank you for attending. But we have muted everyone's lines, and what we would ask is we would still love to hear from you. And as many of you know, I do carry a lot of content. I pack a lot in 1 hour. And so I may not have a great opportunity to answer every question that everybody has. But here's what I'd like to do, or like to do here for you today. I'd like you to go, if you have a question throughout my content, if you would, go into the GoToMeeting question box, type in your question, and go ahead and submit that to me. Now, I may be able to tackle it through the webinar, but based on the content here today, I may not have that time. So what we're going to do is actually prepare a frequently asked question, okay, which will list all the questions posed here during the webinar today. And then we will go ahead and provide that to everyone as part of our follow-up email, okay, to everyone. So please go ahead and type in your question. And again, don't feel bad if I can't tackle it right during the webinar here today. The number one question that we are going to get, it is without fail, is are you recording this webinar? So don't ask, because I'm going to tell you the answer. Yes, we do record each and every webinar. We post the recording of this webinar on our public broker Concierge YouTube channel. And we post that generally 2 days after the webinar. So generally look for this available to you for viewing at your own leisure on Friday of this week. All right, so that should cover the logistics. I already see some questions coming in, so that is great. Awesome, and I appreciate that. So let's go ahead and get into the content. Let's look at our agenda here today. Many of you come from different backgrounds and experience, and so I want to be able to touch on the COBRA fundamentals, and I'm going to do my best to put the fun into fundamentals, all right? So we're going to talk just briefly about COBRA fundamentals. Let's just make sure we're all on the same page, okay, before we get into the mistakes. So let's cover those. Then next, we are going to then take that dive into each mistake. And mistake number 1 is focused on overlooked open enrollment periods. I mean, many of you, as you see these for the first time as far as mistakes, you might say, what? Really, Steve? What? Yeah, and I'm going to respond, yeah, really. These are actually very impactful mistakes that not only could result in some civil penalties or enforcement penalties, but certainly these can cause a larger financial loss for an employer, okay, by not being able to conform to some of these requirements. So overlooked open enrollment periods, you sit here and say, Steve, I help my clients go through these renewals every year. How are they missing on this particular item as far as COBRA is concerned? We're going to touch on that and hopefully cover some action items to help you communicate to your employer how to avoid that. Second mistake is retroactive premium increases. Well, for most plans, each year at renewal season, premiums change. Generally, they increase. And so we're going to talk about a very common mistake that employers are making in regard to retroactive premium increases. And then mistake number 3 actually is really focused on these misunderstood benefits. We come across too many employers that have been focused on providing COBRA coverage for just medical, but they're forgetting the dental, they're forgetting the vision plans that they have. But there's other misunderstood benefits that I think we want to bring to light here today. And we want to make sure that your employer, your clients, new prospects, that they understand what exactly is COBRA qualified and what is not. The last, and what we try to focus on for each webinar, is really the next steps or action items for you, okay, as the benefits broker. You truly sit in a wonderful situation or an opportunity to impact compliance. And so I want to cover in these next steps what I think that you can do to positively impact your clients in this area, maybe specifically for this webinar today, just on COBRA. But I want to bring to light a couple other items here that I found actually in a survey, and I think that this will set the stage for what we ultimately want to talk about here today, which is COBRA. I came across this survey. It is from the National Small Business Association, and this was their 2017 survey on regulations. Yes, they sent a survey out to tens of thousands of small and medium-sized firms and businesses to get a gauge of the impact of regulatory compliance, and its impact on that business, okay? And so I thought some of the statistics and some of the metrics were actually pretty interesting that I wanted to bring out here, at least for you today. Nearly half of all of the businesses that were surveyed said that regulations related to taxation and healthcare or health insurance are very burdensome. So, right, no surprise, right? 50% of these businesses said, holy cow, these just trying to comply or fulfill our obligations are very burdensome. It was the highest level, or I don't know, the worst level, I guess, that you could actually check off as part of this survey. 44%, so just about half of those firms say they spend 40 hours or more each year dealing with just these new regulations, or certainly the existing federal regulations that are out there. So this survey, just keep in mind, was not just focused on healthcare, okay, ACA, those types of surveys. This was on the broader scale of HIPAA and ERISA and the Fair Labor Standards Act and FMLA and companies that are over 50 and under 50. They were focused on not just the federal law, but also on state and local. So it's a very comprehensive look and survey based on the overall regulatory compliance burden that these firms face. And so 44% of small firms had reported spending 40 hours or more just to comply with or deal with these existing regulations, and nearly a third spend more than 80 hours each year. So I want you to think about this. Your clients on a regular basis, and I think they've told you pretty clearly that compliance and fulfilling compliance obligations are a huge piece and part of their business. And I want you to keep thinking about how that's going to impact the decisions that they make, certainly from a healthcare perspective. Money spent on regulations now is nearing or actually over $12,000 a year just that a firm is spending, and these are generally small to medium-sized companies, just to deal with the cost of regulation, okay? Now, you have the cost of, when you think about COBRA, there's a cost to being able to provide that administration to fulfill that compliance requirement, for those former employees, right? When that qualifying event trigger occurs. I mean, there's a cost to that. Well, a firm spends roughly $12,000, and certainly larger firms are going to spend a whole lot more to deal with that. But that's not focusing in on even the penalties. And I didn't put a picture up here for the penalties because that's kind of negative, right? But what I was very happy to see is that 90% of these firms that were surveyed have not been fined for regulatory compliance. Now, that could just be luck. That could be they've been fudging the numbers the whole time and passed the audit. Who knows? They could also not have been audited, right? But 90% have not had a fine for this regulatory compliance, but those 10% that have dealt with an average additional cost over a 5-year period of little over $30,000, $30,600 just in fees, in penalties that were assessed. So, not only do employers have the impact of just, hey, I have to spend a week to 2 weeks or more of my time just to deal with regulatory compliance in a year, but I'm also dealing with these fines as well. One of the questions then that came up, and I'll transition this now into our COBRA and our fundamentals. But one of the questions that was asked was this: what is the number one employee benefit that has been negatively impacted as a result of these high compliance costs due to these regulatory compliance? The number one item, and this is no surprise, is health insurance. Number one. So, when you think about how you go about making your strategies for your employer, talking about how this particular plan or plans, these benefit offerings are going to be most suited for an employer, you need to understand that there are so many other factors, and regulatory compliance is one of those that is affecting the decision that that employer has on your specific solution and strategy. And that's why we've said from time and time again here, and we've really highlighted it over the last couple webinars, is that as a benefits broker, you do need to talk about your specific strategy. You know what? You're an expert. You know what the best strategy is for that client is in regards to that benefit offering. But if you're not aligning your benefit strategy with your client's business strategy, I'm going to tell you what, that client's going to be making decisions that are going to seem weird to you, foreign to you, because they're not going with your offering. Why? Because maybe you haven't appropriately or figured out what the overall client business strategy is. So part of this overall business strategy is understanding what that employer is dealing with as it relates to COBRA. COBRA is just one of those factors, right? One of those things that employers are spending their money on that can have the effect of actually, dictating what benefit offerings are going to be chosen by you, okay? So we're going to start here first with COBRA fundamentals, and I'm going to do my best. You guys know you love to do that in your office chair, right? You want to spin around? Well, maybe your head will be spinning after I get done here with these fundamentals, but I do want to try to add some fun to the fundamentals here of COBRA. But let's go ahead and lay down some of the foundation, okay, of COBRA, because it is important, and I am not going to spend any granularity here, time, with these fundamentals, but I do want to lay some of these out. Plus, this gives you a great slide deck, right? To be able, if you're a broker concierge partner of ours, we're going to give you this slide deck, and it's a great opportunity for you to be able to visualize and utilize this as needed as you're speaking with your clients. So you think about COBRA continuation, right? COBRA continuation involves two primary criteria. It needs to provide, does that specific benefit offering, does it provide medical care, right? Okay, we get that, right? So does it provide for medical care? Secondly, is it maintained by an employer? So COBRA is not going to flow into a specific benefit offering, generally speaking, when it's not tied to medical care, or certainly if it's not maintained by an employer. So if it's an individual medical plan, so on and so forth, COBRA is not going to qualify. But in the cases as a benefits broker and you are rolling out an employer-sponsored benefit offering, generally speaking, that's going to be providing for medical care and then maintained by an employer. And so it's going to cover all of those key group-sponsored benefits, okay? So it's important to understand the qualifying events, okay? And I wanted to do just a brief review of these events here with you. These have not changed. They've been very consistent over the years, but just let's go through them quickly. Number one, termination of employment. This is for voluntary or involuntary termination of employment. Now, I know many of you, I get the question all the time, hey, tell me what the definition is for gross misconduct. And I will reply the way I have for the last many years, decade or so. I'm going to state, hey, there actually is no real definition of gross misconduct that the IRS, the Department of Labor, has certainly provided. I think at the end of the day, you probably will need some advisor, attorney support, possibly, in making that determination. But I also want you to use some common sense. If you've got an employee that has just stolen from your company, right, and you've terminated them, I feel pretty comfortable that that's gross misconduct, and you would not need to offer COBRA coverage, to that individual. But there's a lot of gray areas, folks, and employers have the capability, because that definition has not been established firmly. It does provide some flexibility for an employer to be able to push forth a gross misconduct definition on a particular event versus otherwise. So just know that that is out there. You also have then a reduction of hours. Think about what's happened with ACA, your applicable large employers. They're measuring their variable hour employees. This is happening quite often, right? So we are measuring these variable hour employees through their measurement period. If they are 30 hours or more during that period, we now are offering them coverage. That employee now goes through that stability period, and if the number of hours have now fallen below the 30 hours after the stability period, they no longer have coverage. But again, that reduction of hours, that creates a COBRA qualified event. And it certainly happens quite often where an employee, due to family, to whatever, they go from a full-time employment to part-time or what have you, okay? But that's a trigger. Number three, divorce or legal separation, pretty standard there as a trigger of an event. Death of the covered employee, number four. Number five, ceasing to be a dependent under the plan. That can be because of the age 26, carve out there or roll out, when they hit age 26. But also, hey, you cease to be a dependent under the plan. Number six, entitlement to Medicare. There's many employers, active employees, who actually, though, may be entitled to Medicare because of their age or situation. Doesn't necessarily mean that it triggers a qualifying event here, but it can be one of the 7 events that could trigger a COBRA qualifying event. And then lastly, bankruptcy. That's not employee bankruptcy, that's an employer bankruptcy, can trigger a COBRA qualifying event. All right? So lastly then here, as we look at these 7 events, just a quick summary as well, is the duration. And again, this has not changed, but just to build a foundation. So what COBRA coverage has stated is, okay, if you were enrolled in that medical plan as an active employee, and now you have an event, and now you are offered COBRA coverage, you're now going to be offered that medical plan under COBRA, okay? But based on the qualifying event, it's going to trigger a different duration, okay, of that coverage. And so for 18 months of COBRA continuation coverage, that would fall under the employee's termination of coverage or reduction in hours. Now again, there potentially, during that 18-month period, there could be a secondary qualifying event trigger, right? Death of a covered employee, ceasing to be a dependent. I mean, there's things that could trigger that could allow for up to another 18 months or up to 36 months. But for the sake of the scope of the webinar here today, you have 18 months and 36 months. So at the 36 months of duration of coverage, that's going to cover then the rest. Death of covered employee, divorce or separation, entitlement to Medicare, dependent child ceasing to be a dependent. Now you also have the 29-month disability extension, okay? So what you have is if a former employee during the first 60 days after their qualifying event is determined that they are qualified under the disability extension, then actually the months of coverage would actually be 29 months, okay? So what I also want to have you focus on, I do see one question about, well, hey, I thought maybe that 18 months was actually extended. There are certain states like Connecticut, New York come to mind. There may be other states, but just those two that come to mind that do offer some types of state continuation that's beyond the 18 months. It actually covers beyond the federal guideline of 18 months. So just keep that in mind, that there may be some state continuation requirements or obligations, but what I'm primarily focused on here today is the federal requirement, okay, here for COBRA. Also with COBRA, as we finish up our fundamentals, you think about COBRA as a clock, right? Timing is everything. So it's about timing, and it's also about record keeping. Okay, two very important aspects of compliance with COBRA. Employer, you need to recognize that qualifying event. You need to be able to establish the letters or send letters, and participant, the qualified beneficiary needs to respond on a timely basis. But also employer, you need to keep a timely and an efficient record-keeping system as well. And understand, so in any type of audit situation, you have proof, certainly, of how you timely provided this particular or fulfilled this particular requirement. So timing is everything. So I'm just kind of going I'll go quickly over these steps. It's really to point to just how timing is, or how it comes into play in COBRA compliance. So step one is, and this is kind of wordy here for my first box, but what you generally see here is that you have a qualifying event, okay? So either the employer, because they know that a qualifying event happened, right? They termed an employee, they had a death of an employee. The employer is going to need to notify their plan administrator within 30 days, okay, after that qualifying event. So there's a little buffer period, okay? Now, an employee can have a qualifying event that the employer would never even know about, potentially, unless they're notified by the employee. And so the employee or the qualified beneficiary must notify the plan administrator within 60 days, okay? So that's the first trigger, right? So that's kind of the qualifying event gets things going, and then the letter, the qualifying election letter that will be the response to that initial event happening, that would go out to the qualified beneficiary. The plan administrator must furnish that election notice within 14 days after that notice. Okay, so in theory, if the employer is utilizing an outside, or they've outsourced their COBRA administration, they actually would have 44 days to actually get that qualifying event election letter out to that COBRA qualified beneficiary. Now that letter that is sent is postmarked, right? The best way to be able to have a strong record-keeping system in COBRA is that you mail these letters. First class, they can be certified, but proof of mail is very important. And so that postmark date becomes kind of the moving time that will kind of keep things clicking here in regards to COBRA compliance, not only for the employer, but also the former employee. So the qualified beneficiary must elect COBRA within 60 days. Okay, they send that notice, they mail that notice back to the employer that carries a postmark. The participant then has 45 days from that postmark when they accept it, if they accepted, hey, I think I want COBRA, I'm going to sign up for that, yeah. So they mail that back to the employer, and then they have 45 days from that postmark to make the initial premium payment, okay? And then the qualified beneficiary must be given at least another 30-day grace period to provide that initial premium payment. So when you look at the timeline here, just on a simple qualifying event and getting an understanding from the COBRA continuant whether they want or need or would like to accept COBRA and then make payment for COBRA, you can look at the first payment being made within 150, 170 plus days before that first check is going to arrive in the mail. All right? So you can see to a degree why employers pull their hair out, right? Because they've got to keep a very close record of this compliance effort, because any little skip or miss in this can actually cause some penalties that may not be welcome, right, by any employer. So those are the fundamentals. I don't know if I made that too fun, but anyway, those are some great fundamentals that you need to keep with you as you begin to have more conversations about COBRA with your clients. So now let's start to get into these mistakes. And again, maybe some of you already had a thought on what these three mistakes might be. And I don't know if I've nailed it based on what your thoughts are, but these are three that we see from thousands of our clients and questions and issues that arise with our existing clients. And mistake number one is around overlooking open enrollment periods. All right. So I know many of you are very much in tune and active in the renewal process with your employers. And so I really believe that, certainly as that trusted advisor, you are sitting at a really great opportunity to ensure that this mistake is not made with your clients. But this is very frequent. It happens a ton. So let's just look at this, right? So from a COBRA perspective, we have an open enrollment period that is coming up. Okay, we have a COBRA qualified beneficiary. They accepted to enroll in COBRA back on July 1st. And you actually have your enrollment period for the employer going to start, in December, right, of that year. So you have a January 1 renewal period. So at that open enrollment period, that qualified beneficiary or that COBRA continuant, okay, as they are called, you must offer coverage. If you think about just the primary rule of COBRA, the key rule, coverage must be identical to coverage for similarly situated employees. Basically, if you look at the basics of COBRA, when that former employee would first elect their coverage, I put it in quotes here, they must be offered the same coverage that they had on the day before the qualifying event, right? If they were in the medical plan, they must be offered that under COBRA. If they were not offered dental, then if they were not enrolled in dental prior to the event, then they would not be offered dental, okay, under that initial COBRA event. But I want you to think about, from an open enrollment period process, I want you to think active employees. Active employees would be open to receiving any benefit that they are eligible for. And so a COBRA continuant would be able to have that coverage that's identical for similarly situated employees. But really, in the general theme, it's just, what is an active employee going to be able to choose during this open enrollment period? So some permitted changes. So some issues that we first see clearly is that the employer is not including that COBRA continuant like they should during open enrollment period, or secondarily not offering the available offerings or benefit offering choices for that specific COBRA continuant. So think about this, permitted changes that can occur. The qualified beneficiary, and I'm sorry for all the acronyms here throughout the presentation, but QB is qualified beneficiary. They may change their plans or coverage levels during the open enrollment period. They have the similar option as would be that active employee to change plans, certainly coverage levels. They may need to add covered dependents during that period, right? So that would be a permitted change. Possibly the employer is adding a new benefit that is now available to active employees, and it would be considered a COBRA qualified benefit. So now that qualified beneficiary may elect to participate in the plan. So as a COBRA continuant, as a qualified beneficiary, they have the full range of options to participate in that open enrollment period, just like that active employee. Now keep in mind, these are for COBRA qualified plans that they are choosing from. A key thing, though, that I want to point out, and this is part of the mistake that is being made. So one, they're overlooking these COBRA continuants during the open enrollment period. But secondly, if they are including them, they're forgetting to actually send all of the required materials to that qualified beneficiary. So you need to inform your clients, do not forget, get all enrollment materials, the summary plan descriptions. I mean, if needed, you don't always have to send an SPD out every single year, but depending on the benefit and what's being offered, maybe, or specific amendments that are changed, maybe that needs to be required. Clearly, under ACA and under ERISA, you have the summary of benefit coverage notices, so SBCs, that's going to be required, that needs to be included, and certainly any other documents, that needs to be in the hands of those qualified beneficiaries during that time. So don't forget, this open enrollment period is very important. We have some clients that you have small clients that may only have one COBRA continuant, right? Well, it's still a big deal, still need to offer them the ability for active participation in that open enrollment period. But what if an employer has many COBRA continuants and they're not performing these tasks? Boy, it can be very costly. So this can be a very costly mistake. Let's move to mistake number 2. And that is focused on retroactive premium increases. So as I stated earlier, the majority of the time there is a change, right, to the premium that is going to be offered to an employee on that particular plan. As the renewal occurs, it's just going to change. Generally, it's going to increase. And what employers often mistake or fail to do is they fail to actually offer that increase or include that increase in a prospective way to COBRA continuance, okay? So I want to look at a couple key rules, and we'll cover a few things here as we did with the other here on retroactive premium increases. So the basic rule of COBRA, right, just to put this into perspective, the key rule, you have a qualifying event, you decide as a qualified beneficiary that you're going to accept and pay for the COBRA premium. Well, the COBRA premium is the full amount of the premium that the carrier, in essence, is charging the employer, okay, for that line of coverage, for that particular plan. And so the applicable premium, as it's stated here under the key rule, is established before the beginning of the plan year, and clearly, as you all know, it's generally fixed throughout that plan year, okay? Generally, it doesn't change. So generally that would be the case. So that COBRA continuant would pay that applicable premium. Now, under COBRA, each qualified beneficiary is going to pay that premium, but they're going to pay 102% of that premium just to maintain regular coverage, okay, COBRA coverage, and that 2% is added for the employer or the plan administrator in order for them to administer the plan, right, the COBRA requirements and fulfill that obligation. If a particular individual is or qualifies or is approved for disability extension, right, so that's at 29 months, an employer or plan administrator can actually charge up to 150% of that applicable premium. Okay, so we know that, right? So that's all part of the issue. So some problems that are created with this mistake, and again, this is a very frequent mistake that we see. Well, one, the employer can incur some pretty large financial losses with this, right? If they're in the fully insured space, which many clients are, you have an issue, right? The carrier is now charging the employer the full new premium, the premium that has increased from the year prior, but yet the employer is still charging the old premium, the previous year's premium, to those COBRA continuants. Well, that can be significant based on the number of COBRA continuants that an employer has. So that's a big problem, right? I mean, you right away, as I showed you in that survey from NSBA, they're paying a lot of money just to be compliant. So if you have an opportunity here to save and help them control some cost, that can be a huge impact. Secondly, and this is a big deal too. So the first one is big. I've actually seen some six-figure financial losses from employers by not charging the correct premium to those COBRA continuants. It can be an enormous financial loss. But another piece where you take that financial loss, but now you possibly can turn it into penalties. An employer may, okay, depending on how the administration is established, can inadvertently cause a qualified beneficiary to terminate or be terminated from COBRA for non-payment of premiums. So, for instance, as PrimePay, if we had correct information, or I don't, you know, if we see that the new premium was, you know, $2,000 a month, and the employee is paying $1,800, or the former employee, the COBRA continuant, is paying $1,800, you know, we're going to wait for the grace periods to occur, but we're going to term them for non-payment of premiums because they didn't pay all that they should have. And so, well, what's that going to do? That potentially could cause a civil penalty or a Department of Labor penalty for terming them without actually communicating that correctly to the employees, or to that former employee. I'll get it right. So some key action items. We want to avoid these mistakes. And so the first thing that you absolutely need to do is, you are having your renewal meetings with your employers, you want to take strong consideration as well how you're communicating that to the qualified beneficiaries, whoever is continuing COBRA. And you need to do that on a prospective basis. So that needs to be communicated 30, 60 days prior to that plan year beginning. Now, in some cases, decisions are being made at the final minute, hour, right? Possibly, there's not enough time to make it administratively feasible. So what an employer may need to do, just to stay in compliance, fulfill the requirement of COBRA, communicate it appropriately, they might want to offer these qualified beneficiaries a premium holiday on that premium increase. Still communicate it, but in that first month, they make it a premium holiday on that increase. That does mean that the employer will eat that increase, you know, from the carrier, certainly from a fully insured basis. But that's a key reminder that you can make to avoid this completely. Get them early on with that renewal, with those renewal meetings. All right, mistake number 3. Now this one is this adds a little more content here. We're going to cover a few different benefits, but I put in a picture here of the Misfit toys, right? This is our favorite Christmas cartoon or story, right? Man, it's so good. And this mistake is really focused on the misunderstood benefits, right? These Misfit toys were just misunderstood, right? We all know that. They were great toys, but just misunderstood. Well, your employer is providing some great benefits, and they're not misfits, but these benefits, from the employer's perspective, there are knowledge gaps that employers are making in regard to which specific benefits that they are offering. Are they COBRA qualified or are they not? And so I want to cover some of these specifics, a few here, of misunderstood benefits. The first one here that I want to mention is the health FSA, okay? So a health FSA, as it relates back to the Affordable Care Act, but even prior to that, with additional language, the health FSA is considered a group health plan. I think the Affordable Care Act really put the health FSA into that definition, even more so as it began to talk about accepted and non-accepted benefits. So a health FSA is a group health plan. That means that a health FSA would require that it can be a COBRA qualifying event, all right? And so coverage would be offered if they actually would qualify. The second bullet is very important. Only COBRA coverage would only be offered to participants who underspent their accounts, meaning they elected $1,000 for the year. They currently have $500, available through payroll deductions that have been made, but they've only spent $300, which means that they have $200 sitting there in their account. They've underspent it. They haven't spent everything that they have deducted through payroll through that certain set of time. That is a participant then that would qualify for this COBRA exemption, and they would have to be offered to be able to continue their health FSA account throughout the rest of that plan year. So coverage, it's a little different. We're not talking about 18 months or 36 months. They would only be able to continue that FSA, that health FSA, through the end of that plan year. All right? So too many times we start picking up COBRA, fulfilling the COBRA compliance efforts, administrative efforts for employers, and we notice that they have a health FSA but have never offered it at all. It's never been an offering under COBRA. This is a key mistake that is being made, and it's certainly one that is misunderstood. The second is a little easier, right? Dependent care account. Now, dependent care, right? If we go back to our original definition of COBRA, does it offer medical care? Nope. Okay, so dependent care account, it might be offered by an employer, which it is, but it does not provide medical care. So it's not considered a group health plan. We get this offered quite a bit. Hey, if the health FSA can be offered through COBRA, why not daycare? Why not the dependent care account? So coverage is not offered to qualified beneficiaries, but generally what is offered for dependent care, this is not considered COBRA, but generally there's could be 30, 60, or 90 days of a runout period where that employee can submit claims for expenses incurred while they were employed. So they do have that ability to be able to at least get at some of that money that hadn't been spent when that qualifying event occurs. So as we look under these misunderstood benefits, these first two, a health FSA, yes. Now, a participant needs to have an underspent account. So there's one other qualifying criteria there, but a health FSA is a COBRA qualified plan. Dependent care, no. So it is not going to be considered a group health plan nor fall under COBRA. The next misunderstood benefit is the health reimbursement arrangement. Folks, many of your clients have HRAs. A ton of your clients have HRAs. This is missed on a very frequent basis. So an HRA is absolutely 100%, whether it's considered a integrated or standalone benefit, that amount, that benefit amount, this benefit qualifies for COBRA. And so coverage for the HRA, as you all know, it's a 100% employer-funded benefit, but coverage would be offered due to that qualifying event. And the employer has the ability then, based on the utilization amount each year, to develop a premium that they will charge that former employee, that now COBRA qualified beneficiary. The employer can charge a premium for this particular benefit. Now, as they were an active employee, an employer can't do that, right? It's 100% employer funded. There is no premium or salary deductions that are made by that employee. But when they become a COBRA continuant, that employer can charge a premium specifically for the HRA. So not only for the medical plan, but also for the HRA. The last bullet there is very important. The employer can choose to bundle the HRA benefit plan premium with the medical premium. Okay, so it's just one premium. So for instance, if the premium for the medical plan was for $500 and the HRA premium is at $100, the employer could charge $600, and that employee would have to pay $600 in order to continue coverage for not only the medical plan, but also the HRA. The employer, though, could also have an approach of an unbundled premium approach, and that would be where they offer COBRA coverage for the medical plan for $500, and then a separate line item for the HRA, where the former employee could choose to pick the HRA and pay the $100 premium, okay? Regardless, though, under an HRA, under this arrangement, they are always COBRA qualified, standalone or integrated. The last item here is, or on this page here, is the employee assistance plan. Now, this has come up actually quite a bit. I do know for a fact that many of your employers, small or large, are going to have some sort of assistance in this area. You know what? It's a great benefit, okay? But an employee assistance plan could be considered a COBRA qualified plan. You know, most of these EAP plans can include any type, like a variety, right, of employer-sponsored programs, and these plans seek to prevent or mitigate personal or family problems, right, and these problems could adversely affect an employee's productivity, right, so these are valuable. So here's the question that you need to ask. Does the EAP plan provide medical care? All right, that may, an employer may need an attorney to totally get an understanding, or EAP plan might need to provide details as to that. So that's one question to ask. Secondly, is it staffed by trained counselors, or does simply the EAP refer to physicians or to other counselors, right? So if yes to both of those questions, does the EAP provide medical care, or is it staffed by trained counselors, this EAP design is going to be subject to COBRA. If the EAP is simply referring those individuals, those employees, to other counselors, right? Physicians, what have you, trained professionals, then that's not going to constitute a COBRA, generally, a COBRA qualified plan. So you do need to be very careful with this, and you need to have, as you are making recommendations to your clients, you're going to want to have a firm handle on whether that EAP plan could cause that COBRA qualified situation. So as we look at what's qualified and what's not, HRAs, absolutely, they are a COBRA qualified plan and needs to be offered to those COBRA continuants and qualified beneficiaries. Employee assistant plans, maybe. Generally, maybe for small employers, maybe not so much. But as you get into those medium-sized and larger employer bases, it absolutely could be the case. The last two benefit types that I do want to cover here today, and not many of your employer clients will have this, but I do want to reference this here today. You know, as part of many efforts by employers to control medical cost, you know, and certainly promote wellness, many employers provide on-site medical clinics that kind of have a varied range of services, and it could be from minor first aid types of preventative types of things to sophisticated medical care services. So it's where you get into that sophisticated medical service route. Anything beyond the minor first aid types of services during regular working hours is going to be considered subject to COBRA. And so that former employee who would leave that employer would pay a premium for this particular medical center in order for that employee to adopt it. Now, a lot of cases that employee may not care, you know, and want that, but that still doesn't mean that whether it does or it does not need to be offered. So an on-site medical center, if they offer services beyond that minor first aid types of service, it is generally going to be considered subject to COBRA and would have to be included. The last benefit is health savings accounts. Folks, you would be amazed at the number of questions that we receive in regard to this specific question. So as many of you probably just rolled your eyes, right, right, about it, I am telling you there is a knowledge gap with your employers because we get it all the time. So many of your employers today, probably between 40% and 50% of your employers offer some type of a qualified high deductible health plan that does qualify for an HSA. Now, in every case where an employer is sponsoring a qualified high deductible health plan, that plan will be subject to COBRA, right? Okay, it's because it's a plan that offers medical care and it's maintained by the employer. All right, so the plan itself, yes, COBRA qualified. Premium's going to be determined, and that COBRA continuant is going to have to pay that premium. COBRA does not apply to health savings accounts. So a lot of questions come up. Well, as an employer, I contribute to my employees' accounts. And so they feel that that trigger, that contribution is somehow kind of allowing that account to be COBRA qualified. That is not the case. So regardless of the contribution made by that employer or certainly the employee, that health savings account is truly an individual account that that employee can take with them when they leave, right? So in effect, it is COBRA qualified because they can take it with them. It's their own personal account. But under COBRA compliance, it does not apply. Now, there's some additional considerations on ERISA. Many of you know about the new rule, the fiduciary rule that has come out here recently, and it does have some impact, but I think really less of an impact with employers that have HSAs. But that's ERISA, and if employers just simply allow for voluntary participation, refrain from taking a lot of other certain actions, which is probably abnormal for an employer to do, they can avoid the ERISA. I want you to stay tuned to our next webinar because in August, because I will cover that specific piece of HSAs and the fiduciary rule. So as we look at COBRA, what is qualified and what is not? On-site medical centers or clinics, it's question mark. They can be considered COBRA qualified, but not necessarily. Let me tell you, many medical clinics offer way more beyond that minor first aid piece. So, many of these are going to be considered qualified. But then lastly, health savings accounts, no, these are not going to qualify. All right. So 3 common mistakes, right? I mean, in the scope of things, we look at a lot of knowledge gaps from these employers, but these are gaps that you can absolutely fill. And I truly believe that you have, as that trusted advisor status, you can make a huge impact with compliance. And I'm not talking about the impact that, such as that picture, that is the complete devastation of the earth, okay? I am talking about a very positive impact that you can make. So as you think about this survey that I had mentioned, right, talking about how these firms are dealing with compliance, COBRA is just one of those pieces, these parts of the compliance pie that must be tackled. But your communication and your practical application of what they need to do can save them an enormous amount of financial losses just from these common mistakes, but also can save them quite a bit in unneeded types of excise taxes or penalties from the Department of Labor or the IRS. Both of those divisions or departments enforce COBRA. All right. The IRS started here several years ago. Department of Labor was from the beginning to enforce this. The IRS here today, and this is specific to the IRS, they can impose an excise tax. So this is not even including the Department of Labor, which is the standard $110 per day, right, type of penalty that can be assessed from the Department of Labor. But specifically, it can be up to $100 per qualified beneficiary per day. If it's 2 in a family, it's $200 per family maximum. And so this could potentially go back to, and I'm showing here a worst case scenario here from an IRS perspective, just in excise taxes, where it could result in $146,000. It can be impactful. The Department of Labor can go back a little further. Plus, let's not forget civil penalties that could also be presented as well. So you can greatly impact the excise tax penalty exposure here tremendously here for non-compliance. There are key next steps. A lot of these next steps are simply questions that need to be asked. These can be questions that can be asked by you. It can be questions asked certainly by the employer themselves. Many times an employer is not fully aware as to who is responsible for what specific COBRA activity. Generally speaking, the employer is a plan sponsor, so they're responsible for it all. But not necessarily as far as the daily activity. It could be the carrier is responsible for some part of the activity, certainly the employer. A TPA, such as PrimePay, or certainly you as the benefits broker. The initial rights notice letter is missed a lot for all new hires that come on board who are eligible for benefits. Wow, when employer was the last time you sent out the initial rights notice letter to all employees who are eligible for that? Maybe you have employers that are on the bubble of the federal law versus the state continuation laws. You know, they're sitting in that 18, 20, 24 type of numbers. Well, what law should I be following? Do I come under the federal law, or should I be fulfilling things under the state continuation requirements? Don't forget, as we just went through the mistakes, to talk about that health FSA, the HRA, some of those other benefits, and ensure that the employer, don't assume that they are doing it correctly. You need to ask them and talk about it. COBRA notices have absolutely been revised since the start and implementation of the Affordable Care Act. This goes to initial rights notice letters, and it goes towards the qualified election letters. There's new information about the federal marketplace. It has further language in there in regard to ACA. And so it's very important that your employers are utilizing the revised notices, all right? Lastly, is where you can step in is literally performing an audit of your current COBRA procedures with that employer client. Now, PrimePay has created a free COBRA audit checklist, and this covers the 15 items. If the IRS ever came into your employer, your client, to perform a COBRA audit, the IRS has stated that they are looking at 15 items. They tell you exactly what they're going to audit for. And so what we've done is we've put down these 15 things on this checklist, and this would give you an opportunity, whether you're sitting with a prospect or certainly kind of reaffirming compliance obligations with your existing clients. Here's an opportunity for you to go through a very simple checklist to see if your employer clients are actually fulfilling these particular rules and obligations. So when you look at COBRA specifically, you can look at a lot of compliance requirements in a lot of different areas. But when we think about COBRA, employers frequently fail to do these 7 things as it relates to COBRA. I realize that I talked about the top 3, but these 7 are just key things that we brought up when you're doing your kind of free audit checkup there, using that checklist with your clients, but things that you need to discuss. You know, are you providing the initial rights notice letter notice to the new employees? Are you providing the adequate or appropriate qualified election letter notice to new qualifying beneficiaries, you know, where a qualifying event just occurred? Are you recognizing a qualifying event in the appropriate timeline, right? Are you terminating coverage when allowable? We had a client here, a broker, kind of anecdotally tell a story where they had let former employees on COBRA continue to pay for COBRA well beyond the 18 months or the 36 months. So much so that we got up into 6 figures in relation to when, you know, of how much more was paid when they shouldn't have been paying under COBRA at all, that they should have been under the plan, terminated under coverage some time ago. Offering all COBRA eligible plans, right? So that's part of mistake number 3, the misunderstood benefits. Extending COBRA timeframes correctly. Told you timing is everything with COBRA, and so that extension of COBRA timeframes, or just understanding those timeframes, are very important. And then lastly, as I said, not only the timing, but the record keeping. One of the key things that the IRS states as part of their audit process is that they ask each employer whether they have or whether they can review their COBRA procedure manual. Do your clients have a COBRA procedure manual? You need to ask the question. But it's a key common mistake that employers are not properly documenting their COBRA activity. So as we think about that proper documentation, clearly I would be remiss to say that we here at PrimePay have performed this process very appropriately and have helped employers fulfill these obligations near to perfect 100%. And we do ensure here at PrimePay that every client that does sign up with our service, that we will provide that COBRA procedure manual to each and every client. So I do want you to consider PrimePay. I would love for you to be able to reach out to our broker concierge team. And I want you to ask this specific question: how can broker concierge help me, my agency, drive this content and actually remove this knowledge gap with our employers? And I know our broker concierge team, our passionate broker success specialists, will be able to totally provide the information you need there on how we can bring that to life for your clients. So we'd love to earn your business in that respect. As follow-up to our webinar today, I'm putting up here on the screen, our key contact. If you have questions about the content, you have questions about how PrimePay can actually assist your agency in driving better compliance knowledge and solutions to your clients, I know our broker concierge team will want to help. So please reach out to us with the numbers and information there above. As follow-up to our webinar today, we are going to be providing a link to the recording for our BC exclusive partners. We will be providing in our broker portal the presentation slide deck from today. That is huge, guys. You can have this content and use it as you're presenting to your clients this great information, right? Also, there's going to be some newly revised kind of BC briefs on addressing some COBRA compliance needs. I talked about our checklist, but we're updating a couple other things that I think you'll find valuable here as well. I want you to join us for our next webinar on the first Wednesday of August, August 2nd. I'm excited. I always get excited about this. We're going to perform our annual compliance grab bag webinar. Guys, this is rapid fire. We're going to cover several regulatory compliance issues. We're going to hit it hard and fast and really come up with some strong, quick, practical applications that you can apply toward those regulatory items. So please join us for our next webinar, actually coming up here very, very soon. I also, as you see here in the just above, thank you for attending, many of you have said, hey, we'd love to get our clients to some of your webinars. You've got some great information. Do you have anything that's upcoming? If you go to that link, primepay.com/news-press/event, we actually have two great client webinars coming up just next week, July 18th and July 20th. The July 18th is focused on a very strong HR topic. It's called The Secret to Recruiting and Hiring. It's also approved for 1 hour of HRCI and 1 hour of SHRM credit. So I know that many of your HR professionals for your clients would really enjoy that. The July 20th webinar is on ERISA, and it's going to provide a very strong educational content, information, practical application as to how your clients need to comply under ERISA. So with that, you guys have asked some great questions. I may have been able to tackle a few of them, but we will be providing kind of an FAQ here as follow-up to our webinar, and we're going to get that out to everyone because there's been some great questions. Thank you for attending today's webinar. We look forward to seeing you here again here next month, and please feel free to reach out directly to our broker concierge team for information on how we can directly support your agency. All right? Have a great day, and that will conclude our webinar.